yesterday was not easy for anybody. I don't know. I know some very, very good traders that lost a lot of money yesterday, and did it mechanically. The hardest thing for me,
Mhm.
and you and I talked about this offline, but look, I had stop losses in place for some of my trades that were blown through. Meaning,
Mhm.
I put and this is an important lesson: limit stop losses, not market stop losses.
Yep.
Okay. I never appreciated the importance of that for the last 5 years until yesterday, because especially in the futures market, if you were to get the bid price or the ask price, mostly the bid if you're closing out for selling options or selling future options, if you got the bid price yesterday, what should have been a spot of maybe, let's say I get a trade for $10 credit and my stop loss is $30 debit, so I'm going to take like that 200% loss or 300% loss. The market would have put it in yesterday. The bid price would have been maybe 100, maybe 150. It would have been like a 10 to 15x loss if I just had a market when it was filled at open bell. So I took a bit of a risk yesterday where I let some of my P&L fluctuate and float. And so I'm not gonna lie, man, like things looked pretty crappy yesterday. And I'm
Same
not
here.
saying they can't turn crappy, but what I did put on yesterday as I was actively trading through it Sunday to Monday was a lot more hedges just in case I'm going to let these P&L fluctuations happen.
Yeah. Well, and the thing is, Chris, I was kind of given this rant too about thinking about if you're somebody who you have to ask, we're not financial advisors here. We're not here telling individuals what they should do in their account. But one thing you should be thinking about at home is what are your personal objectives? If you're somebody who's like, I'm trading to make gains for my long-term future,
Yep.
then again, you got to be ready for bigger swings like this, especially if you're taking larger, risk, if you're, employing any sort of, trying to trade more aggressive things, like if you're trading tech or if you trade, it's not your standard buy SPY and hold it. If you're trading, you kind of accept bigger swings both up and down. So one thing I wanted to point out too today, Chris, is this turnaround of the VIX is aggressive. We've got VIX down 27%. But here's the thing. I was looking at this, and again, I'm not saying I think this is what's going to happen, but we had environments like this back in 2020. Now, 2020 is so unique because it was such a peculiar kind of market where we saw the global shutdown due to a pandemic. But we did see these big shoots up in the VIX, followed by aggressive sells. Then it would renew again. Then it would come back down. Then it would renew again. And if we do one more test, if we go back to 2008, which is the real deal, similar concept. You had these big explosive VIX moves. People get kind of back into being bullish, and then it shoots up again. So here's a question for you. Is this, bounce back? Do you trust the bounce back? Are you positioning for a bigger move higher across the indices? Or are you playing it more like I'm going to take profits where I can pretty quick in anticipation for possible renewed VIX energy to the upside? What do you think?
Well, I think what was really revealing yesterday is it was essentially just a 1-day vol event that was built up over weeks and weeks and weeks of waiting. Think about how the market topped over in July when we had 6 all-time highs in 6 trading days, and then finally started to peak and topple over. So that it's right there. It's right there. It's right there. Look, we've been talking about this all year. Low volatility, historically low volatility. That is a problem because the market finds a way of delivering, maybe once a year, maybe every couple of years. But I mean, you just mentioned some of the biggest. I mean, this was the second largest vol event in a single day that we have ever had since 1990 in the VIX.
Yep.
But that is something to remember. It was one of the. I'm trying to think what else statistic wise we had. One of the bigger. Hang on, I've got some interesting factoids here from yesterday. Let's see here. I mean, 90% of the market was down yesterday. Somebody had mentioned if CNBC comes on today and says markets in turmoil, that's typically a nice contrarian indicator. You guys might throw that in for the Edge Finder when you're Bloomberg's and CNBC's are like markets are red. It's like usually it's a great thing to buy the book.
Yeah, right. Yeah, that's so true.
So anyway, my point is with the VIX. I mean, I don't think we're all of a sudden going back to 12 Okay, I think what we'll do, and I'm looking at the the term structure here. I think that we will probably stay in the 20s, which is higher elevated volatility. I mean, if you have a 25% VIX, okay, or I should say it's more like a 25.9 move. Look, if you're getting the S&P to move a quarter to half percent a day, that's a decent move. I mean, a lot of times the market's essentially zero sum. There's ups, there's downs, but it goes very little from a day-to-day gain. And so if we're getting like half percent moves, 1% moves every single day, that's a lot more volatility than we just came from. But look, I mean, I'd like to see, and it may not settle down for the next like 60 to 90 days. But
Yeah.
if we go from 65 and it was a one and done, we're probably going to stay pretty elevated between like maybe in the 20s and 30s. So look, I'm prepared for the worst, dude. After yesterday, it's like it clearly showed some gaps in my trading that I need to tighten the hell up. And
Yeah.
one thing
No, I
I'm
mean,
always trying to
me
do is
too. And
improve. So it's like I need to like be more forceful with my hedges and make sure that when an event like that, and this is what's stupid, man. There's so much good trading on a day-to-day basis, and week to weeks or months to months, that a day like yesterday, it's like, well, shit, I can never let that happen again. And I hate
Yeah.
the fact that now in the back of my mind, it's like, I can't let that dude, I manage too much money to let that happen, to
Yeah.
let that type of like one day, move that's like, I'm down, 10% a day. That's ridiculous. And it's tick for tick with the markets, and I've got hedges on. So I just need to make sure that that doesn't happen.
I'll tell you something, Chris, too, just by, also doing this for better half of a decade at this point. I have been surprised many times by the market. Yesterday was also another day of learning for I think a lot of people.
Yep.
Unfortunately, a lot of people, blew up yesterday and they lost a lot of money, and even, talented traders can lose a lot of money in a surprise shift in the market's volatility. It is 101. We have talked about that 37,000 times on the live stream, and that might not be an exaggeration. We have talked about the idea of the VIX being low, and then it shoots back up. It challenges everybody's morals. It challenges everybody's, strategies and systems, and it is very, very natural. But one thing that I will say to people listening is that this is why, over the very long term, I have trended more and more towards boring, slow and steady trading over anything else, because I want to be doing this 20 years from now. And the only way I can know that I'm going to be doing this 20 years from now is to employ so much defense in my account. I need to accept, and I'm saying this personally, I know, Chris, you probably feel the same way. It is more important to employ more defensive measurements to save yourself when things go crazy than it is to try and maximize your gains when things are going easy.
Did you know that we have 100% free trading tools and data available for you on our website, a1trading.com, right now? We have free courses for you to browse. You can also check out things like retail sentiment and free articles from our analyst Frank that include things like Edgefinder screenshots and trade setups. You can find all of this and so much more for free right now on our website, a1trading.com.
Yeah, I agree. And look, we'd all love to have, the markets just be up and easy and buy the rip and sell the dip and do it every single day. But yesterday was a very harsh reality check. It really was. Things to take away from it based on today's price action. Look, we're consider it lucky that yesterday, did you trade actively yesterday? Did you actually start establishing some new positions? I know that you're very quick to cut off losers and get back in where you like and give things a chance. Which is
I didn't
awesome
play it perfectly whatsoever, Chris. Unfortunately, as you can imagine, I got stopped out on the open yesterday. I joined back into my trades, but they had moved a good bit ahead of me. So again, a learning experience for me too is just, man, that was no fun to get stopped out, market rips. And then I still liked the trades, saw the price action on a 4-hour chart, went back in. But I did buy some things that were a little bit more aggressive. I've told you I've been more on the tech side of things. I bought semis. I put a big chunk of the account into semiconductors, which of course is ripping today. But sticking true to just what we just talked about, I am actually thinking about trimming that size just from you start looking at things differently, Chris. As soon as you have a spike in volatility and you see market downside can be so relentless, you start thinking, okay, I want stuff in my account. I do want the high growth, high potential stuff in my account, no question.
Right.
But the sizing of it is very important. So,
For
you know,
sure.
your Bitcoins, your semiconductors, your tech trades, your individual stocks, you start looking at things just very differently.
Yeah. And look, let's talk short term versus long term. Okay. Short term, you can forget about yesterday. If you're a short term trader that somehow has the luxury of not being exposed and necessarily having a portfolio, yesterday maybe didn't matter at all. Maybe it was just a good day of volatility for you. But longer term, I mean, it's a scary time, and it happens. And when there's, this happened. This is the biggest move we've seen in 34 years. It's like, that's memorable. If you look back on a VIX chart and you see that, oh my gosh, this type of move happened in 2020 when the world shut down. This happened in 2008 when the financial markets were on the brink of global collapse. It's like, how is that possible? But this was just, like I said, this was festering and bubbling under the surface to have.
Can I show you something, Chris, based on what you just said? Check this out on my screen, guys. So a lot of different ideas floating out there. I've heard some more frustrating ones, like, for example, oh my gosh, Kamala Harris is going to be president. I'm just freaking out about, Kamala Harris, that's the reason the market stops. The politic fight people, people who just like rave in comment section about politics are a different breed, man. But anyways, that I think is the smallest component. Now, jokes aside, the uncertainty about the president is probably a bearish factor for the market right now. So the uncertainty about who's going to be the president is bearish. Not it's going to be bearish because it's going to be Trump, or it's going to be bearish because Kamala Harris. That's not what I'm saying at all. The uncertainty of who's going to be the president, that uncertainty is something the market shies away from. It's like trying to put two positive magnets together. They don't like that.
Correct. Yeah.
The market doesn't like that uncertainty, but that's not why the market sold off. And I don't even think that it was just the jobs data being poor on Friday. I think Friday's jobs data triggered something in the market that is scary. And it is scary for a good reason.
Yep.
Because if we take a look at what happened on the commitment of traders data on a week over week filing, the carry trade unwind, there was some good evidence of it happening, but a lot of people saying, everybody's buying the yen. They are, but the way they're buying it is the point that you got to be careful with. They're not buying the yen because, the yen looks great. They're covering yen shorts. And this was apparent in the last 2 weeks of commitment of traders data. The change in short contracts on the Japanese yen futures were just violent, but there was some buying, don't get me wrong, but it was drastically outweighed by short covering on the Japanese yen and the Swiss franc. Now, the question then becomes, is that going to morph into a sustainable market sell-off? Well, I think we have to walk backwards, Chris. We have to think, what triggered this? Okay, jobs data on Friday. Where's our next economic data that's going to trigger a surge in buying back? And maybe in the short run, we could see further downside volatility because there's more short covering that causes more short covering, your classic short squeeze. But for me, I think that there's enough liquidity, there's enough money in the system that could try and cover that. And this is my opinion, I could be wrong about that. But what would break that again would be a fresh round of really poor economic data to trigger more fear. But right now, we've got a little bit of a runway where the market doesn't have a bunch of new economic data in front of us, right?
Yeah, that's a good spin on what I thought was like, oh fudge, we have no real data coming in, so the market's going to be either, too much momentum has tipped it over, where now it's just like sell and get out, and it's just a flush because it perpetuates that kind of happy trigger selling. Or like you just said, that's a good spin on that, where maybe there's no data to lean on. And so the market's just waiting for the next catalyst, and maybe it's Jackson Hole, which is towards the end of this month. I mean, realistically, if I'm looking at the Nikkei, I said this yesterday, all my live sessions I did yesterday, I'm like, we need to see the Nikkei go up Tuesday. Because if it goes down Tuesday, then this is going to get way worse. And if you thought Monday was bad, Tuesday could be even worse, because now you have more people like catching their breath and covering their butts and figuring out what's next, and who knows what's going to happen. But this, high frequency trading and algo trading, and just when like alerts and levels get triggered, there's so much liquidity that can go and snowball into these directions and I promise you this moving forward, the markets will move faster now than we ever thought. I mean, dude, I've been in this market for a long time, And yesterday was like, holy crap. And at the same time, it's like, it could have been way worse, Nick. It could have been way worse. I mean, the Nikkei has dumped 27% in like 3 weeks of trading. It dumped like 20% in the last 2 trading days, you know? So that's what's out there. And that's the stuff that like lingers in the background or bubbles under the surface. And so again, you talk about, I meant to bring this up earlier, 10 years out, 20 years out. There's never been a 20-year period in the history of the markets. You could have traded at the absolute top of 1928 or 1929 and still 20 years later made money. Not 100 years later, 20 years later. You could have traded during World War at the top when the market, it's like all the crashes, all the worst things we've had happen. If you go to the worst possible spot 20 years later, 100% of the time you've made money. So if you have that type of outlook, nothing like this really matters to a long-term investor. This is a buying opportunity for a long-term investor. Look, NVIDIA may not be top 1, 2, or 3 in 5 years, right? NVIDIA might fall off the face of the planet and be toast. Who knows? But I will say that the S&P is going to continue to push and pump and prime the top companies in the world.
Exactly.
And maybe that rotation happens.
To add to your thought there, Chris, too, with being a long-term investor, you also have to understand, not you, but to our listeners, understand what Chris is also saying. We are active traders. We're not sitting here saying, oh, we're just buying and holding. What we're pointing out, though, is that great trading and long-term investing share more similarities than differences, because great trading is just employing a system. You know, think about like if you were to long-term invest into a singular company, you're basically investing into their strategy. Like if you invest in NVIDIA, you're saying, I believe in NVIDIA's strategy for growing this business. Think of your trading as an individual stock. You have a system, you have strategy, just like a company, you have your own P&L, you know, how much you're making, what business plan you're going to take. Same thing with trading. So even if you are an active trader, even if you're scalping the 10-second chart, having a long-term investment mentality when looking at the markets is really important. Because if you're somebody who I can't handle a losing month, or I can't handle a couple weeks down, the markets are going to be rough for you, because that is like having a mentality where, you just show up, you get paid every day. And trading is not a job. It is really, truly a long-term investment.
Interesting fact for you, Nick. This is coming from a guy that I followed there. I know you and I've talked about him. Charlie Bolello brings a lot of great factoids to the market, and he just delivers data, and I freaking love it. So Nikkei 225 declined 17.5% over 2 trading days, the largest 2-day decline in history. Again, another fantastic outlier. Like, hey, I remember Monday, August 5th. I mean, part of me thinks like, let's just talk headlines. Was this a Black Monday 2.0? Was this a Black Monday 2024 type thing?
Certainly felt like
feels
it.
like that.
Yeah.
Right? So Nikkei down. It kind of was a taste of contagion for the day. Look, it was crazy, dude. Like, call it intuition, I guess. Call it a hunch, because Friday was a pretty nasty day. Last week, from Wednesday, Thursday, Friday, things changed very dramatically. So I wasn't surprised to see like Sunday's futures market rolling into Monday with a huge gap lower. Anyway, back to this. The Nikkei returns 1 year following the previous largest declines in the Nikkei. When it happened in 1987, a year later, it's up 25%. When it happened in 2008, a year later, it's up 43%. When it happened in 2011, it's up 18%. That does not mean I'm calling the bottom. In fact, what I would say price action wise on the Nikkei would be, look, it's nice to see that the Nikkei was up, 10% overnight. I think that's a huge win for stabilizing the markets for right now. And as you said, if there's no major news, I call this the tuning fork, right? Where we have this type of plunge. I mean, if we take out this entire day, to me, that's a good thing. But obviously the concern as far as price action is this now a high low, lower high to lower low to finish out this corrective move? Or is this going to be, we flush down here, we go sideways, but this essentially puts in the low, and then the market maybe uses that as a double bottom. And then 12 months later, as history shows for the other 3 bad sell-offs, now this is 4, what is it 12 months from now? So I'm just curious, like, I'm going to mark this on my chart. I'll be here a year later, I promise. One of the worst, 2-day sell-offs ever. And I'm going to say that from here, this would be one of the largest 2-day declines. Where are we? 12 months later. Okay, I'm just going to mark that on the chart and put a little box around that, because look, I did this when we started our rate cut cycle in the US, because there's a history of when the Fed starts cutting that we're usually 9 to 12% higher, and we end up being like 16% higher. So there's a reason that we look at history. There's a reason that I like as much data as I can get. There's a reason I like the Edgefinder Pro.
Yes, sir.
There you go. So I'm going to mark that on my chart just as a reference. And, look, there's a couple ways that I trade it. I'm still long the FXY, but it's mostly a hedge. It's been that way since day one. The FXY is up in position. I'm up around $4 a share.
Yep.
Big whoop. But the EWJ is a way that I can trade the Nikkei as a US trader. And it's not the same. Like this is all-time highs in the EWJ. We know that this year, after a 34-year hiatus, we finally broke all-time highs again in the Nikkei 225. So it doesn't quite change the market. But what I thought was interesting on EWJ is this actually cuts out the bottom 15% of Japanese stocks.
Interesting.
So I thought that was interesting. Like, well, if you take the bottom 15% and get rid of them, how good would that be for the S&P right now? If we have a new ETF and spin off the S&P to like the S&P top 10, right? I mean, that'd be one of the best performing ETFs ever.
Yeah, it'd be a monster performer.
Yeah.
I'd be curious to see what that index would look like over a long stretch, though, because I'd be curious, because there's probably times where it, greatly underperforms.
Sure.
And then
it's still
really...
dude. It's going to be like, for the last 20 years, it's going to be a tech. It's going to be a tech index, right?
Yeah.
And that's right now the biggest argument that we're seeing is tech going to be this like too expensive, rotate out? It's going to be a value play. Look, all the value investors out there, and it's interesting, man. A lot of podcasts that I consume and listen to, value investors, macro guys, and they are just underperforming year after year after year. And look, this is a competitive industry. If you're managing money, it is a competitive space. And I don't know how these guys, as value investors, can justify underperforming year after year after year. Because when they finally do better, it's not like they're doubling and tripling gains, man. It's like they're just beating the benchmarks. And so it's crazy to me that you can have this narrative of value, and just underperform.
I think if you pitch yourself, just a thought, I am no professional in the managing money space, but I imagine if you pitch yourself as I'm my benchmark. If you want a lower risk, money management, if you are, benchmark me against the consumer staples ETF, instead of the S&P, because this is going to produce, what is it, beta or alpha or whatever, less downside, beta, sure. Right? The idea being, if you invest with me, this is what we're going against. We're not going against the SPY, which has higher drawdowns. Maybe this one, which has less drawdowns, this is what we're trying to beat. That's just my guess, because that's what I would think that their sales pitch would be, because value is going to beat the S&P 500, Chris, in an environment that is no fun whatsoever.
Exactly. And maybe that's a good thing, is you can get that kind of, you can plant that seed of fear where it's like, look, if things go bad, your money is safe. Yeah. This is preservation of capital. I mean, I would say this, you've got the pitch against, consumer staples, or you could also say risk-free rate. We outperform the risk-free rate, which right now at 5.5% with zero risk in the market, that's a pretty attractive thing, considering we just had a 10% haircut or a 18 to 19% haircut in the NASDAQ. But look, like I said, go back to what we said earlier. 20 years from now, probably going to be fine, right?
Yep.
10 years from now, there's like an 85% chance you're going to be making money. It's like, it's so much to look at, like every 10, every 20, it's been great. Let me ask you this. Is the stock market like the greatest financial tool ever, or is this a Ponzi scheme? And let me add to that. Think about all the forced buying that this market has every single month. Forced buying meaning pensions, 401ks, targeted funds. You have, I thought this was really interesting. So for every employee that puts themselves into a 401k plan, that is about a $17 add-in to the market. For every employee that leaves the workforce or takes away their 401k and pulls it, it's like a $2 withdrawal. So you have a huge bonus or this huge surplus of every employee that puts into a 401k forced buying to a targeted fund that's either, balance of stocks and bonds. I actually, I think I may have mentioned this on the show yesterday, in a very boring way. I reallocated my entire 401k portfolio Sunday and got ready for this week. So I went a little bit more large cap quality, and I went a lot more money market, because as I can get short-term treasury still at 4.5%, almost 5%, I'm going to take that in the short term right now, and then I'll get out of that probably by the end of the year as we start to see the rate cuts taking over and the bonds look way less attractive. But I'll get that last little bit of risk-free, tame down the volatility a little bit, and my 401ks, I have one that I can't get out. I can't be self-directed. I've got one that's self-directed. I've got one that's just in targeted funds. So the one that is me not managing it, it's up like 10% for the year, which is fine, because it's kind of like a put money in it rainy day fund, but it's allocated to be, it should be fine, right? And it's fine. Yeah. It really hasn't had any pullbacks, but anyway, point is,
Chris, my wife and I, we're working towards buying a house at some point. We have this secondary account, and it has been, it's our house fund account, and it's still invested in stuff, but I took the ultimate defensive approach in that account, maybe a year ago. And for the most part, in the last year, I've been like, what am I doing? This account has done nothing for me.
Yeah.
What is so amazing is that in the last 1 month, that account's up like 1.5–2%. And it's in, a good mix of bond ETFs and, dividend companies and utilities and staples. And it was just a reminder in the last few days that, diversification, which I have strayed away from in my primary trading account recently, is important, and sizing is very important. And you look at some things like, if you're looking at U.S. stocks, to your point about, is this a big Ponzi scheme? There will probably be a day where we kick ourselves for saying we should have probably had some allocation to emerging markets, or we should have had some allocation to Asian stocks, which I know you already do. But my point is, stuff rotates in and out of this market. What is hot today may not be hot tomorrow. Historically speaking, you mentioned earlier that maybe Nvidia's, the big stock in 5 years, maybe it's not, but companies rotate in and out. It's personally why my sweet spot, I don't trade a lot of individual stocks. I like to trade the indices. I like to trade commodities, things that I know will still be around in 5 years. Just a personal preference.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.